Hey guys, welcome to another video of Parvez's Trade. And yeah, on this video, I wanted to talk about something related to trading, which has been in the when you guys watch, for example, like the Wolf of Wall Street movies or any other movies where they focus on a banker or a trader, it's all about instincts and guts when you're trading and making money. But that industry has changed rapidly in the last few decades. So ever since the end of the 80s, around that time, a new phenomenon came in to trading industry, the Western world, which is basically quant trading, as they call it, or quantitative trading. So you're basically trading using math. And in simplest terms, I'll just give you an example. I mean, again, I'm overly simplifying when I give this example, so just keep that in mind. And so, one sec. Yeah, so basically, let's say, let's keep it simple. Let's say you're trading asset, okay? The asset price has reached, there are, let's say, 100 price points, okay? So 100, the asset has traded for, let's say, 100 minutes so far. Let's keep it simple. And out of the 100 minutes the asset traded, let's say every 10, out of the 100 minutes, there were 10 minutes where the asset traded for a price of $200. So that means, based on this historical data, 10% of the time, right? 10% of 100 is 10 minutes. So 10% of the time, the asset traded at a price of $200. And so if you're trying to bet on the future price of the asset, you can use that as a probability baseline. Okay. So yeah, like, to make it even simpler, let's say out of the 100 minutes, the asset price was $250 in 51 minutes. So 51% of the time, the asset traded at $250. So you can bet money on that. And let's say the asset price is right now at 240. Okay. And you're trying to sell the asset price at 250. What's the chance that the asset price will hit 250 now? Well, based on historical data, 51% of the time, the asset price was $250. So I have a 51% chance, based on probability, that the asset price will hit $50, $250. And yeah, and now the idea behind this is that over time, you'll make money by betting, by buying any price below 250 and trying to sell at 250. Okay. And I know it sounds very complicated so far. To keep it simple, um, so when you flip a coin, okay, the chances of it being head or tails are 1 in 2, 50%. But if you flip the coin a few times, you'll not get equal head and tails. You'll have to flip the coin hundreds, thousands of times. It's called the law of large numbers. So you have to keep flipping the coin and get a large sample size. And after thousands of times, you'll get a sample that's close to 50 heads and 50 tails. Okay. And any probability, any event that has a chance of occurring. So the coin toss is in probability industry, the coin toss is called the baseline, the random variable. So 50% head, 50% tail, equal chance of each event. That's called a random variable, random event. Okay. It's completely random. Okay. But if you can quantify an event that can happen at more than 50% of the time, let's say 51%, That means what? Over time. So I have asset, the stock A. There's 51. If I'll go through the historical record of stock A price, and 51% of the historical record, the stock price hit $250. Okay. So every time the stock price went below $250, I buy it and I try to sell it at $250. And I repeat this trade thousands of times. I'll end up with a sample where I make more money than I lose. Because if I repeat this trade thousands of times, I'll end up with a sample of 51% time to price hitting $250, and then 49% of the time price not hitting, price staying below $250. And the idea is that because over time you have more than a random variable 50% chance of hitting the asset price, you will make money. But you have to do the trade repeatedly, thousands of times. And so it does come with a lot of flaws and nuances that you have to take into account. Okay. And that's basically the idea behind probability-based trading. You're trying to find what we call an edge in the market. Okay. What's your edge? Okay. What kind of trading strategy you have uh, that can give you return, uh, profit return 50, more than 50% of the time. And that's basically the idea behind it. And I find it quite stupid if you think about like, just to be honest, I look, I'm a numbers guy. I like math, but I find this probability-based trading quite stupid because first you have to do thousands of trade to take advantage of the law of large numbers to get a big sample size for your probability to actually work. And then there's the transaction cost within large amount of trade. If you're trading in an illiquid market, not a lot of liquidity, the spread will be high, and so the transaction cost will increase for thousands of trade. And so if you're trading in an illiquid market, the transaction cost will be higher, and so you'll need an edge of more than 51% because yeah, or if you do thousands of trade, 51% of the time you're making money, but you have to subtract that profit from the high transaction cost because of high spread, because the market is not liquid, because there's not a lot of volume trading. And the market is usually liquid when the bond interest rates are high and money flows into the bond market, which is what we're experiencing right now. So this probability based trading works well, and it did work well in the 90s, 2000, 2010s. This probability based trading worked very well because the bond interest rates were close to zero in Western countries. But you don't have that anymore, right? And so you're going to live in this high interest environment for a long time to come. And so this probability based trading will, unless you have a serious edge of like 70% outcome, you know, chance of it hitting the mark, uh, yeah, you're going to lose more money in transaction costs than you're going to make money by trading thousands of times and getting the probability hit. So yeah, I think that there are a lot of nuances to this kind of trading, and it doesn't always work out. And also, it only works in a very liquid market with large volume of trades going on. So that's why I'm not a big fan of this probability-based trading. And so when people talk about, trading with statistical analysis, chart patterns and all that, they basically, the fundamental idea is this probability. They're doing all this chart pattern analysis is to find an edge of having an outcome of their wish of their net profit being hit more than 50% of the time. But those kind of trading is not going to work in this market, which is very illiquid. So yeah, you do have to be careful and you have to take it with a pinch of salt when you're trying to apply these probability-based trading models. And yeah, that's one thing I wanted to get out of the way when you'll hear this a lot in the trading industry, especially if you work as a professional trader. They talk a lot about this, probability, and it'll come up when you're trying to do interviews in trading. But just understand that there's only a under very specific conditions in the market will this work. But even then, you might have to do thousands of trades before you get your result. So yeah, that's that. But now the question comes down to, so how do you trade in a market with low liquidity, high transaction cost, and where you can't get an edge by doing a probability analysis? Well, I talked about this in previous videos. You have to find a geopolitical analysis edge. Okay, you have to have a niche. I'm not saying you have to understand fundamentals of every geopolitical event, but if there are certain geopolitical events around the world that you believe you understand better than what they're saying in the mainstream media or somewhere else, and you can make a good prediction on how it'll pan out, bet on that and you'll make money. Okay. I think there you'll have a better edge than going through all this historical record and doing this probability analysis. That's just my 2 cents on that. And yeah, that's it for this video. And next video, I'll start talking about the Forex market. How trading in Forex market is actually pretty easy and pretty simple. But also, obviously, just like any trading, it does have some nuances and there are some limitations when it comes to trading in forex market, especially if you're trading on your own versus if you're trading with a big bank's money. So yeah, we'll talk about that in the next video. And until then, peace.